So for net working capital, first thing we're going to want to do is open up this NWC tab. And we're going to start out by linking our revenue cells from the income statement. And you'll see it's from 2016 onwards. Go to total revenue for 2016 from the income statement. Carry that forward for every year in the historical period. All right, and then now we're going to just pull forward the revenues that we projected out in our free cash flow tab. Move that forward, Control R, and we are good to go. Now, we are also going to pull our cost of goods sold from the historical income statement. So we're just going to go 2016 here as before, and just move that forward. Alt ESF, and that pulls it forward without messing up our formatting. And now, if you look at 2021E, there's no COGS in our free cash flow tab. So to project that out, basically what we're going to have to do is first look at the percentage of COGS. COGS is the percentage of sales or revenue. COGS, sales, and revenue are the same thing. So we are just going to go to the income statement, and we're just going to take cost of goods sold as a percentage of sales. I've already projected this out for us. And we're just going to press Alt ESF. That's going to move that forward. And by hitting Alt H, 0, it increases the decimal point by 1 place. And now we are going to, keeping this in mind, we are going to go to 2021 to 2025, and we're just going to project COGS out as the average percentage of sales. So we're just going to get the average, hit F4 to lock that range in place, and carry that forward. Oops. And there you go. So now from here, we can project out COGS as 74.8% of each year's revenue. This works, and this works well, because if you think about it, now we're just projecting out, as revenue grows, how much will COGS grow by? And by tying COGS to revenue, which inherently is how it works, we get a pretty good estimate of that. Now, for our first line item for our current assets, because if you remember, net working capital is essentially just current assets minus current liabilities. To build out our current assets, we just go to our accounts receivable and inventory, the two biggest line items for this company. Obviously, when let's say that you value a tech company, they're not going to have a lot of inventory. So you'll look at their assets, see, what are the biggest line items that are significant, and you're just going to pull those. But for this, it was AR and inventory, so we're just going to pull this forward for the historical period like we did before. And we are also going to figure out what accounts receivable is as a percentage of revenue. Carry that forward. Just double check by hitting F2 to make sure everything's linked the way it should. And keeping that in mind, we're going to go up to this handy dandy box above here, and we're just going to hit average. We're going to find the 5-year average accounts receivable percentage number as a percentage of sales. So keeping that in mind, we're going to do what we did before. Oops. Okay. Hit equals, and we're going to link that to that 1.18%, F4 to lock in place, and move that forward. And now we're just going to see, okay, we know our accounts receivable is going to be 1.18% of our revenue. Move that forward for each year, and we have our AR. Same thing for inventory here. We're just going to link from the income statement, balance sheet, and we're going to go to inventory here, move over the historical period, Alt ESF. Sometimes it doesn't want to work. Alt ESF. Okay. And now what we're going to do is we're going to do our inventory, divide that by our cost of goods sold. And the reason we're doing this as a percentage of COGS and not a percentage of sales is because if you think about it, inventory is just unsold COGS. When you sell a product, it gets decreased out of inventory and becomes increased in COGS. So it makes more sense to get a more granular, more, more knowledgeable, more accurate model. That's the word. To get a more accurate model, we're going to project out using inventory as a percentage of COGS. Now, keeping that in mind, we're going to go back to our box up here, and we're going to get that 5-year average like we did before. Okay, and we're gonna link that below here, just like before. Hit F4 to lock in place, and we're gonna move that forward. Control R or Alt ESF, because there's nothing to worry about in terms of messing up formatting. Now, do the same thing as before. We know inventory is gonna be 11.74% of our total revenue. Get those numbers, make sure they link. Always, always, always hit F2 after you put in formulas to make sure everything's tying out the way that you wanted it to. And now we have our total current assets. You'll notice here, therefore, I'm going to add accounts receivable to inventory, and we're going to carry that forward for all the years. But if you notice here, we don't have cash. And cash is the current asset. I promise our accounting teachers are right in that. But we don't include that here for one very good reason. Let's say that I included cash of, gosh, maybe 50 bucks here. Okay, made that part of our current assets. And that's for 2021E. Let's go back to our free cash flow tab here. Now, essentially with this 2021 hasn't occurred yet, but I've put down that 50 because I think that'd be my guesstimate. Maybe I projected out cash as a percentage of sales like I did for all the other current assets. The whole point of a DCF and these free cash flow tabs to figure out what would the free cash flow be year over year. So if we include it in our change in net working capital here when we're trying to calculate free cash flow, we've double counted cash. And what's the point of doing the whole DCF to begin with, right? So we don't include that for that reason. And as we move into current liabilities, we don't include any debt, any current portion of long-term debt or short-term debt for a similar reason. It's because we account for that in our weighted average cost of capital calculation, which is in a later video. But moving on to our current liabilities, we're going to do pretty much the same thing as before. We're going to link accounts payable over to our balance sheet. It's up here, and then move that forward for each year in our historical period. Okay, and now from here, we're going to find, okay, what is accounts payable as a percentage of cost of goods sold? And we're doing this as a percent of COGS too, because for a company like Walmart, which is, a retailer, their accounts payable usually stems from, paying suppliers for the inventory that Walmart holds. And that, obviously, like I said before, inventory is tied to COGS. So it makes sense to tie AP to COGS as well. So that is there. I'm going to get that formula going. And for a similar reason, just keep in mind, accounts payable and accrued expenses are very similar. But while accounts payable kind of, targets suppliers mainly for a company like Walmart, accrued expenses are going to be more general purchases that more general expenses that Walmart owes but hasn't paid. So while accounts payable might be, an invoice for some tennis balls that Walmart hasn't paid for yet, accrued expenses would be stuff like salaries that are still to be paid and stuff like that. So difference here. I mean, that's kind of also the reason why while AP is a percent of COGS, accrued expenses are a percent of sales, because it really doesn't make sense to, project. Accrued expenses are a bit harder to, tie to COGS and still be true to the model and all the accounting rules. So, but back to accounts payable. To project out, we're going to do the same thing as before. We're just going to go up to our box here, hit that average, get that 5-year average, highlight all 5. And now we're going to link below using our trusty F4 key. Control R to copy over. And now we're going to multiply that by our COGS. That's why it's important to hit your F2 key to make sure you're doing it right. So Control R, we are good to go here. Accrued expenses, like I said before, are going to be percentage of sales, but we're going to link those figures from the balance sheet here. I'm just going to copy these forward. Cool. And now we're going to find out what are our accrued expenses as a percentage of sales or revenue. Copy that forward. And remember, we're using Alt ESF here because, there's the risk that if I did it using Control R, it would mess up our formatting as such. Actually, it worked this time, but usually when you hit Control R, sometimes you run the risk of carrying forward that left border with you. So just as foolproof measure, we use Alt ESF, but sometimes Excel has a mind of its own. So it really depends on the situation here. But nevertheless, we're going to pull those accrued expenses down to our box here, or up to our box here, 5-year average, and we're going to link that here. F4 to lock in place, carry that forward, make sure it's locking the way it's supposed to. And now we know that our accrued expenses are 3.95% of revenue. Carry that forward. We're good to go here. So now we know our current liabilities, our accounts payable, plus accrued expenses. And this is kind of the point I was getting at before. If I hit Control R here, it carried forward those borders with you. We don't want that. So we're just going to do highlight the cells we want, Alt ESF after we copy. Check. We are good to go here. So now our net working capital is just going to be current assets minus the current liabilities. And that all works. So now our change in net working capital, that is just going to be our New Year's net working capital minus the old year. So carry that forward. And essentially, this is an interesting, little semantic for a DCF. A negative change in net working capital means that the company has actually gained free cash flow for that given year. That's interesting, but it's an interesting thing to wrap your head around. But the concept of it is, if you look here, in 2016 we had $50 billion of current assets. In 2017 we have 48 billion or 49 billion about. And what that tells us is, okay, from 2016 to 2017, even though their accounts receivable has increased, which means they gave products, but they didn't really earn cash for them yet. But at the same time, if you look at it, their inventory decreased. And what that tells us year over year, when your inventory decreases, is that you got rid of inventory and you had to spend less cash to update it, to replenish it, which means that you've had a net increase in cash year over year, right? At the same time, if you look down below at the current liabilities, you see that they've increased. And basically what that tells us is, the company owes more accounts receivable over 2016 in 2017 compared to 2016. And they owe, and basically what that tells us is that this is money that they should have paid, but they haven't yet, which we kind of treat as an increase in free cash flow because, they're expenses that have already been logged, but cash hasn't been paid out yet. So we want to adjust for that. So that's why we include it in our net working capital, in our change in net working capital. And if you see the combination of the decrease in inventory and an increase in AP, that is enough to get us to a negative change in net working capital, which means we've had an increase in cash for 2017. So the only thing left to do now is to link our change in net working capital to the free cash flow tab here. So the way to do that is we're going to navigate over to the 2020 column, hit equals negative, and by pressing Control page down until we get to the NWC tab, pull our change in NWC for 2020. By using Alt ESF, we're going to carry that formula forward, and we are done. And one really important thing to remember here is that the reason that we put a negative sign in front of each formula in this row is because of what I said before. If you have an increase in net working capital, it actually means that you've had to pay money year over year to maintain your NWC, right? And that means that you've had to pay a certain sum of amount. And you want to reflect that that amount that you paid is no longer free cash flow available to all investors. And vice versa, right? If you have a negative change in net working capital, that means that you've had an addition of cash for that specific year, and thus you want to reflect that we have additional cash that all investors can access. And that concept is very important to know as you try to navigate, learning more about DCFs and just net working capital in general. So, but with that wraps up this step.